Today we have a fantastic guest. We have Kathy Lenart from Taylor and Lebo. I'll have her introduce herself and talk a little bit about what she does. But here's the scenario. I've come across many clients over the last 6 months. A lot of them are high income earners, but also have a lot of debt and carry a lot of debt. And so, in my mind, I'm like, well, what are some options? How can we start to solve this? So, I want to bring on somebody who's really an expert in this field. So, Kathy, tell us a little bit about yourself and what you do.
Thank you, Dwayne. Kathy Leonard from Taylor Lebo. I'm a licensed insolvency trustee. So I know when you hear that insolvency and trustee, it's always kind of a scary word. But what we basically do is we help individuals and businesses who are struggling with overwhelming debt. So there is legislation there that can provide them with the relief. And we sit down with them and go through their situation to see what solutions can we come up with to help them move forward. I've been doing this for a very long time. I've kind of heard a lot of different stories, and everybody's situation is unique.
Agree with you 100%. And that's why we've got some great questions we're going to go through. It's going to be very conversational. And then afterwards, if anyone wants to connect with Kathy, I'll have all of the information in the description notes with links to websites and stuff like that and contact information. But yeah, I think it's important. I think it's a hot topic. We're seeing lots of news articles, especially lately, with people that are missing payments on mortgages. I'm seeing a lot of people that are trying to consolidate some debt. So I'm sure there's many folks out there that are looking for answers on these questions too. So we'll just jump right in with the first one, and let's talk about maybe what are some of the common reasons people are struggling with debt, and when's kind of the best time to reach out to someone like yourself.
Yeah, as far as the common reasons, money mismanagement is kind of the high level overview as far as what the reason is. Lack of budgeting, right? Overspending, that type of thing. Unfortunately, we don't do a very good job educating people through schools and life in money techniques. So they don't track their expenses. They don't know where their money is going. It's amazing how many people come in to see me, and when you're trying to figure out what their expenses are, they don't know where their money is going. So that's a big one. High cost of living, high interest rates, which you're very familiar with. You can say a little bit more about how much a change in a percentage of interest rate is going to impact a high mortgage. Loss of employment. We went through COVID. Lots of people were off work, lost employment, that type of thing. Loss of a business. Businesses are still struggling. So, yes, we had some relief. They're coming around, but there's lots of businesses out there that unfortunately are still not able to make it. Um, Separation of marriage. When you go from a household which has two incomes to now doing it on your own, you just can't afford the same things. Helping parents and children. I'm seeing people who are kind of in that middle, I think they call it the sandwich, right? Where you've got parents above you and children below you that you may be helping financially. And high medical costs, right? Just
Hmm.
those things that potentially are not covered that are really taking from your ability to pay your living expenses and your debt. So those are kind of the reasons. I don't know if you see anything different in people that are coming to refinance with you.
I think there's a lot of times it's really just lifestyle driven, like especially with people that have high income. They just, I agree. It's kind of more aligned with what you had said with just knowing where money is going and budgeting and looking at the cash flows. It's so easy to get debt, like, and it's so easy to get credit. So like it's those two things. If you make those things easy, I think you run into it. And honestly, you look at people that are just driving cars and making payments that are like $1,000 plus just lease payments a month or more, and then they've got multiple cars. Credit cards are maxed, and it's I start to see it's a lot of lifestyle driven, and then all of a sudden you're thinking you're in a situation where, hey, I make a lot of money, I can afford all this stuff, and then you start to see, oh boy, I've got like a unsecured line of credit at 100,000. I have a credit card that's maxed out at 50 grand, and then I have another one. So it starts that huge snowball effect. And unfortunately, you throw in increasing your interest rates from like a 2.5% to a 4%, and now your mortgage payment is doubled. You throw that in the mix, and people start struggling. And I'm also seeing it from rental properties. A lot of people were buying rental properties in the heyday a few years ago when interest rates were lower, and now these properties are just not cash flowing, right? So things like that I would find from my side, anyways.
Yeah, those are a great couple additional points.
Oh, thanks, Kathy. And okay, so back to that other question, just the last part, Kathy. When's the best time that someone should reach out to someone like yourself?
The earlier the better. So as soon as they feel maybe they're starting to struggle and don't know what to do, most licensed insolvency trustees offer a free initial consultation. So we will sit down and we will go through the monthly income, expenses, assets, liabilities. Did anybody co-sign this debt? Have you transferred any assets? Have you filed your taxes? So we will look at their full financial situation and talk about what solutions potentially are there. So it may be that I'm telling them to go to a bank and try and consolidate their debt. It may be that I'm saying, go see Dwayne and see if he can do something for you. There's some equity in your house that maybe you can get at to refinance this all together. So I may not be able to help them, but in that initial consultation, I will be able to educate them as to what some of their options are, and then they can make an informed decision moving forward.
So the earlier the better. I agree.
The earlier, the better.
Yeah,
Yes.
good answer. And so that leads me to kind of the next question that I get a lot, and that is, what is the difference between like a consumer proposal, which we've heard about, and a bankruptcy?
Okay. So they're both under the Bankruptcy and Insolvency Act, which is the legislation that I use for everything that I do. So in a bankruptcy, basically what happens is the assets vest in the trustee, which means I have to realize on any value that they may have. If they have income above a certain threshold, they have to make surplus income payments into me. I have investigative powers, but anything that comes into me, I then distribute equally to all of their creditors. So it's kind of bringing them back to a minimal position and eliminating their debt. They are accountable to me during that whole time. They are protected from their creditors during that time, but it is a little bit harsher and it is going to impact their credit rating a little bit more.
Mm-hmm.
A consumer proposal is basically saying, okay, I don't want to go bankrupt. I can't pay you in full. I'm making my minimum payments and I'm not getting anywhere. So can I settle somewhere in between? So we look at what the creditors would get in a bankruptcy and we say to them, okay, we're going to offer you more over a maximum of a 5-year time period at a monthly amount that the person can afford. So it's giving them the relief that now, okay, I have one payment. There's no further interest on this. The trustee's fees are included in it. I don't have the creditors coming after me. I'm not concerned about a garnishment or that type of thing. And it is a little bit softer on their credit rating. So they keep their assets and they make a monthly payment. A proposal can be very creative though. So the proposal could be that I'm going to cash in an RSP and do a lump sum and then monthly payments. Or I'm going to settle on this and make the monthly payment. So we can work out what is affordable to the individual.
Sweet. That's pretty clear and straightforward. So, what do you typically find? Do you find that clients of yours lean more towards the proposal versus the bankruptcy, or is it just every situation is different?
Every situation is different. So the proposal is good if you have assets.
Mm-hmm.
So if you have equity in your house that you can't settle over that shorter bankruptcy time period, or if the surplus income calculation is a monthly amount you can't afford, the proposal allows you to do it over a longer time period.
Mm-hmm.
So that is easier. I do find people, though, that potentially are on ODSP, they have no assets. A bankruptcy is probably the easier solution for them, and they just won't do it. They're like, no, I want to pay back at least something to the creditors, so I will do a proposal at $120 a month.
Mm-hmm.
So it really just depends on their circumstances and what they're looking at going forward and how it's going to impact their credit rating, what they want to look in their future and how that may impact them.
Mm-hmm. And then when it comes to like around misconceptions around insolvency, what are you seeing that people are basically, what are the big myths that people think are happening around insolvency?
Yeah, and I'm sure you see, I think every profession sees this, that you have people that come into you and they say, well, my neighbor told me, or
Hmm.
this person told me to do this. So I think one of the bigger misconceptions is that you lose everything in a bankruptcy. You
Right.
don't. There are certain exemptions which allow you to keep your household furnishings, a vehicle up to $7,100. RSPs, if you haven't made a contribution in the last 12 months, they are exempt and can't be touched. So when I see people that are cashing in their RSPs to pay their debt and still struggling, it may be that there's a better solution for them.
Hmm.
Tools of the trade, they're worried about being able to continue to run a small trade business if I take away all their tools in their truck to get there. There's an exemption for that. So you don't lose everything. It's kind of bringing you back to that basic level to allow you to move forward. You can also settle on that equity. So when you talk about high income people, we do have individuals who may have equity in their house of $80,000 and have make a good living, but they've got $250,000 in debt.
Hmm.
So we can look at formulating either a bankruptcy or a proposal. So it is there to give them the fresh start to move forward. Tax debt. Lots of people come in and they're like, oh, I owe income tax, but I know that can't be included in a bankruptcy or a proposal. Well, it can. Personal income tax debt to Canada Revenue Agency is a debt just like every other credit card or everybody else that you have. So, personal income tax, HST, if you're a sole proprietor, they can be included in a bankruptcy or a proposal as long as it hasn't got to the step where they've registered a mortgage on title of your house. So, back to where we talked about seeking help early, that's where it's best to come and get the financial options so that you know what you can do. Student loans. People think they can't be included in a bankruptcy. Treatment of student loans has changed many times over my long career, but currently it's that if you have been out of school for more than 7 years and have not returned to school, student loan debt can be included in a bankruptcy or a proposal as well. So they're trying to ensure that you're not getting student loans, graduating, and filing an insolvency a year or two later, because hopefully there's the potential that you will earn a future income from that education. But if you've been struggling and have been out of school for more than 7 years, that student loan can be included as well.
Interesting.
Those are
Interesting.
a
I
couple
learned.
big ones. I don't know if there's any that you can think of either that you're aware of.
The other one I see from time to time, and I know this is just a question I've come up with is, let's say you're doing a bankruptcy or a consumer proposal, and you've created, you have your whole list of items that are going to be included in that, but then you forgot something. Like, does that ever happen, and how does that work?
It happens all the time because people are overwhelmed. So they come
Right.
in to see me and they're trying to remember, who do I owe? What was this debt? Is it me? Was it somebody else? So in a bankruptcy, it's pretty easy to add anybody. So anybody that you owed at the date of bankruptcy is part of that bankruptcy. If you forgot about them and it is a large creditor and you didn't remember until 2 years down the road, we can send the notification. But if the creditors got a dividend from the bankruptcy, so if I realized on an asset you made some surplus income payments in a bankruptcy, because some people think they don't pay anything, you do. So if the creditors maybe all got 10 cents on the dollar back, and you forgot to list a creditor, you'd still be responsible for paying them that 10 cents on the dollar. So you
Got
kind
it.
of have to bring them back to where they should have been. But during the bankruptcy process, from the date you file until I'm doing my final statement of receipts and disbursements, if they think of an additional creditor, they just have to let me know and we'll send them notification.
Hmm.
A proposal is a little bit different. Again, it includes all debt at the filing of the proposal. But when you're doing a proposal to your creditors, I'm saying to them, okay, based on what we're offering, you're going to get back about 25 cents on the dollar. If you forget a major creditor and a year down the road while you're in that proposal, you find out you missed a $20,000 creditor, that now impacts that percentage that people, the creditors have voted on. So we may have to amend the proposal to increase what we're offering so that the creditors are then at the same level and the creditors have to re-vote on that.
Interesting.
So it's not the end of the world. You can deal with it, but you just have to be aware the proposal may have to be increased.
Nice. Okay, let's move on to some mortgage questions, and because
Near and dear to your heart.
yeah, of course. So, how does a consumer proposal impact someone's ability to renew their mortgage or their ability to refinance? And I think I'll let you go first, and then I'll talk about it from a lender perspective.
Perfect. Yeah. So in a proposal, you can keep your house, right? So you continue the mortgage payments, and the proposal is to the unsecured creditors. Your mortgagee does have to get notified of the proposal, but under the legislation, they can't call the mortgage just because you filed a proposal. So you have to make sure you're current. You don't want to give them any other reason to be calling your
Mm-hmm.
mortgage, but you can continue on with them. That's not an issue. Typically, when mortgages come up for renewal, and you can confirm this, it's just rolled over. So, yes, they may have gotten the proposal documents, but you've made your payments, they'll just roll it over. If you're looking to refinance, change, get a better interest rate, I'll throw that back to you to answer.
Yeah, and that's where we run into an issue. So, I think that if we just do talking about the proposal, the one thing is like they're they're gonna renew with you. Like anything, if your credit score is changed, if you missed a payment or two, that sort of thing, your rate is what's probably going to be impacted. So, I've got quite a few clients that, have gone through bankruptcies in the past, still have gone out and purchased homes and got mortgages, but you're typically starting on the B side. You're paying fees to the lender, fees to myself. You're paying higher interest rates, but it's getting you into a home. And if you have the proper coaching and you follow a plan, eventually we'll get you from the B side to the A side, right? So, but really, if you're in a consumer proposal or you're doing a bankruptcy and you have a mortgage, yeah, they're gonna renew. Your rate might not be the best rate, and it typically isn't in a renewal anyways. So you want to have that advantage to shop it around. So I would say that's the impact is your ability to now go out and shop that around because no A lender is going to do a refinance on somebody that's in a proposal. You basically have to be out of it for at least 2 years, right? So we'll talk more about that later, but I would say that's the big impact from my side. Cool. Let's go back to you on okay. So we've done all of this. We've done a proposal. We've done a bankruptcy. What are some steps that you help with your clients to give them advice on how to rebuild their financial health and get back to a normal place of normalcy after an insolvency?
Yeah, and the insolvency is there to provide relief to an honest but unfortunate debtor.
Mm-hmm.
It's also supposed to be rehabilitative. So there are 2 counseling sessions they must attend. Those counseling sessions talk about budgeting, money management, keeping track of your expenses, and the second one about rebuilding your credit. So typically, what I see the best thing is that they get a secured credit card, right? So they use it, pay it, and they're putting, the 30% on there, groceries, gas, that type of thing. Those are on the credit card to help rebuild after the fact. You have to be cautious about not just going out and applying for a whole lot of credit because we've got this hit on your credit rating. And if you're just applying and getting rejected, that's going to affect your credit rating as well. So it's baby steps you have to take. Like I said, in a bankruptcy, we make them track every single dollar they're spending. They have to fill in a monthly report that they're sending to me. This is what I'm spending on food, phone, that type of thing. I do get many reports that are very round dollars, and I'm saying to them, I'm not sure if you're quite keeping track of everything. I want you to write everything down. But it is working with them through that process. So hopefully they don't end up in the same situation again.
Mm-hmm. Yeah, I agree, and it's almost like when I'm speaking with first time home buyers, it's amazing how little they know about credit. Like, and a lot of them are at this stage they understand budgeting, like they understand their income and they understand a balance sheet basically for their budgeting. But when it comes to how credit works, how different credit vehicles work, how interest works, I find that we just do a really poor job educating people on that. And I think that's some of the reasons why a lot of people get into debt, so quickly.
And I
So
think they might have changed the curriculum in Ontario that they've added. Um, I'm not sure in what course, but a little bit of component that talks about credit and that type of thing. So maybe that'll help to educate our future.
I hope so. I can tell you, my wife's a certified financial planner,
Okay.
and so she taught our kids at a very young age, and I was horrible with money when I went when my girl, because my parents never taught me about any of that stuff, so I got into debt and trouble really quick.
Yeah.
But I look at how well our kids are doing, and it's like, wow, you're saving, your credit rating's great, you're paying for things yourself, you're budgeting for stuff, and it's just that little bit. It's not like she spent hours, but just a little bit of advice, and it's amazing how if you just take it, that you can be in a much better position. So hopefully it does change. Okay, so let's talk about credit scores a little bit. How does insolvency impact your credit score? And then we'll follow that up with what we can do to help improve our credit scores.
Yeah. So a bankruptcy goes on your credit rating as an R9 to 6 to 7 years from discharge. So I think TransUnion and Equifax, one of them 6, one of them 7. I never remember which one. A proposal is an R7 for 3 years from completion or 6 years from filing, whichever comes earlier. So it does end up on the credit rating for probably about the same amount of time. It is also a permanent marking, so superintendent of bankruptcy does track all insolvencies, so it will stay there forever. And as far as I know, people ask me the impact on the actual credit score number. I don't know that answer. I'm not sure if you do.
Yeah. Well, when we're talking about credit scores, I'll just talk to you from like a mortgage perspective. Somebody gives me an application. The first thing I'm going to do is check their income and that sort of thing, looking at the documents. But the next thing I'm going to do is I'm going to get them to sign a client consent for credit. We're going to run. I use Equifax, but we're going to run a credit report. And first thing I'm doing is looking. Okay, look at the score. Yeah, that's important, and your scores will range from a mortgage lending perspective, will be from like 500, like, and that's on the B side, all the way up to 900 is where I see that. And where the big impact comes from is how you're managing your credit. So things like, are you paying things on time? Are you is your credit utilization high? And what I mean by that is, like, if you've got a $10,000 credit limit and it's sitting at $7,000 month in and month out, that's going to have a pretty big impact on your credit rate, right? Things like that. And if you're and like you'd said before, if you go out and apply for a whole bunch of credit at the same time and get declined, that's going to impact your credit. Things like that. And a lot of people think, well, oh, I should just cancel my credit cards. That actually will impact your credit, because you want to have a history. So if you have a credit card that you've had for 20 years, but you're not using it as much anymore, and you cancel it, and then you go get a new credit card that you had for 2 months, well, you don't have any history with that credit card. So there's so many things that will impact it. But the first thing I do, like, I'll look at the credit score, and if you're above the 600s, we're okay. We're in pretty good shape. I have lenders on the A side that are going to be able to do a mortgage for you. But what I want to look at is, I'll go through and look at the report, and I'll look at, okay, are there R1s? So meaning, are they making payments regularly on other stuff, or are there R9s or anything higher? And the lenders, what they care about is, they know that people get into situations. They just want to know the story. If somebody went through a messy divorce, if somebody went through a huge medical, if somebody lost their job, there's a story that goes along with that. But if somebody's just high risk because they just don't pay their bills and they get a bunch of credit cards and walk away from it, well, that's very high risk for a lender, and they don't want to lend mortgages to people like that, right? So that's typically how I see it impacted. I think to improve the credit score, I think, do you want to take that one, and I'll add to it as well?
Yeah, and I think what I just said about a secured credit card. So
Hmm.
it's baby steps.
Yes.
People think, that as soon as my bankruptcy's done, I'm going to go out and get this credit. Well, no, don't do that. You have to take the baby steps, accumulate the savings, get a secured credit card. use it, pay it, not maximizing the utilization.
Right.
Then maybe a year down the road, okay, go in and talk to your bank. Can they offer you a credit card? Can you get an RRSP loan? Have you got a car loan that you've been paying? So it's not, like I said, it's not jumping into it. Unfortunately, probably the easiest credit cards to get are more your store credit cards. So your Home Depot, Canadian Tire, that type of thing. Um, but they have the highest interest rate. So if you're getting into those again, you have to be really cautious that yes, they can help you rebuild your credit, but you are paying that off in full every single month. I had one individual a long time ago when we were talking about credit cards. And when I was talking about rebuilding credit, and I said, okay, have this and use it and pay it every single month. And she said, well, why would I have a credit card if I'm not going to carry a balance? So it's just the thought process. The credit card is there more for ease of use. It shouldn't be there as a loan.
Absolutely. And I think for me, it's we just use the rule of twos. So you just want to have two trade lines. So you want to have a credit card or a line of credit. You want to have two things that you're paying on a monthly basis and you're utilizing on a monthly basis. You want to have that for 2 years, and lenders are looking for at least a minimum limit of $2,000. So that's kind of your goal to get to. I like what you're doing there. Go get yourself one of those credit cards where you get a minimal amount, get used to it. I would not max, like, don't go for high credit limits right out of the gate, and then make sure you've got a strategy, like very clear budget. Like you said, put your groceries. You know that you have the money to pay for things. Put that on your credit card and then pay it off immediately. Right, get
Yeah.
that thing paid off. Just show that you're starting to establish that. And I think it's for me, what I would add is just be aware. Be aware of your credit score. A lot of people bury their heads in the sand and they don't even look. Like, I'll give you an example that actually happened to me that impacted my credit score. I had a credit card. I made the mistake of canceling it because it was it was a business credit card, but you're attached to it personally, right? And so I didn't use it anymore. I canceled my bank account and moved to another bank. So I thought, okay, I'll just use another credit card. Well, I canceled it, and for some reason, they charged me after they canceled it a $25 annual fee. So I didn't know. I buried my head in the sand. I thought it was canceled. I didn't, I had everything was I'm sure they probably send me an envelope that I just threw in because what is this? And I made the stupid mistake of not opening it. But for $25, they literally sent that to collections. And my bank calls me. It's like, by the way, did you know about this? And I'm like, no. And so I fixed it. But amazing how little things like that could impact you, right? So it's just don't bury your head in the sand. Look at your credit score. You can do it for free on Equifax or TransUnion. You can subscribe if you want to. I think most banks, like I know with RBC, I go into my app. I can check my credit score right in my mobile app. I don't think many people even know they can do that. So that's what I would say around the credit score. And then
And like you said, with your credit reports, right? Many people, if they're going to Google credit report, TransUnion, or whatever, you go, it directs you to the page where they want you to subscribe for a monthly amount. You do not have to do that. You can get a free credit report on Equifax and on TransUnion, I think, every 6 months.
Mm-hmm.
So if you kind of diarize in your calendar every 6 months to check your credit report, there's so much fraud and identity theft and everything else going on out there. It's just really prudent to pull the credit reports, check and make sure that there is nothing unusual on it, and fix anything as you go. Don't wait till you're trying to buy that house and want Dwayne to get you a mortgage. Fix it now.
100%. Don't bury your head in the sand.
Yeah.
And talk to somebody and know how do I solve this. You don't have to pay people to solve it. It's just understanding what's impacting your credit rating. The only way to know is to look at a report, right, and see what's impacting. Okay, we'll move over to some mortgage related questions in a bit, but I've got one big question, and this I get from time to time from clients too. It's okay. What other options do I have for people that want to avoid insolvency but are in a huge debt situation? Is there any other solutions that they have, with the exception of going a proposal or a bankruptcy?
Yeah, and the other two options that we talk to people when they come in and we're looking at their financial situation is like a debt management program. So
Okay.
there are great not-for-profit credit counseling agencies out there that will negotiate with the creditors to accept payment in full over a 4-year time frame. So you are paying the full debt. Sometimes they can get the interest rate lower. And the benefit is that you're just dealing with one person as opposed to dealing with multiple. Again, they're a credit counseling agency, so they also have resources with respect to the budgeting and all that type of thing.
Hmm.
But just be cautious with who you're going with. Make sure they're accredited. Do some research on them. The second one is a debt consolidation loan or a refinancing. So going to your bank and seeing, will they consolidate everything into one debt? If you've got credit cards at 20 something percent and you can get a loan or something at 10%, you're going to be saving on a monthly basis significantly and actually paying it down over that 4 or 5 year time period. If you have equity in your house, we tell them, you know what, go look. Can you get a second mortgage? Can you refinance your first mortgage? When is it up for renewal? And then we tell them to go speak to somebody like you.
Yeah, I appreciate that, Kathy. Yeah, okay, cool. I think those are good answers, and maybe we'll put some links into some of those free non for profits as well. Any questions for me on the mortgage side?
Of course. We need you to educate us here as well. So, how does a mortgage agent help someone struggling with debt who wants to keep their home? I know when I have people come in to me and they're looking at their options, and even I think with any service, they're always worried about the extra costs and that type of thing. But there's obviously benefits to everything. So, how can you help someone?
So the first thing is, and I'll clear this up as a myth right away, is we don't charge fees. Like just to do a consultation, do a mortgage review, go through, provide solutions for you. There's no fee. There's no cost to doing that. So why not do it, right? So that's the first. That's the first thing. The other thing is we don't just look at getting you a mortgage. We look at what is your goals. Let's start there. We know we're in a situation, and it's just a situation at this time. Doesn't mean this is forever, but this is a situation we're in. But what was your goal when you first started, when you bought that house in the first place, right? So it's like, yeah, I wanted to have an investment for my future. I wanted to be cash flow positive. I didn't want to be in stressful situations. So there's a lot of people out there, I'll tell you, Kathy, that have no idea how much equity they even have in their house. Like people that, especially, I work with a lot of seniors, especially like people that are in retirement, that are on fixed income, bought a house that's worth $60,000 years ago, and now it's worth like $1 million, and they're struggling with their debt. They're struggling to make monthly payments to their stuff, and they're just struggling to buy groceries. So the first thing we're going to do is look, okay, what's your goals? What's your current situation? We'll look at all of your liabilities. We'll look at your income. We'll look at, okay, what are you trying to get to on a monthly cash flow basis, right? So what do you want your monthly payments to look like, and what can you manage? So then at that point, then we start to put together solutions, whether it be a refinance. So a refinance just means changing the whole mortgage, adding to the mortgage, and typically, right now our rates are great. So we have really low interest rates compared to where we were, a year and a half ago. And when you compare that to high interest debt, like I'll see people that, make $300,000 a year, but have $300,000 in unsecured debt. And I scratched my head. I think you and I talked about this. I was like, how? And it just happens. Life happens. So how do we get out of that situation? Well, we'll do a refinance, and then we put together a plan after the fact to pay down that mortgage as fast as possible, right? Using prepayment privileges and stuff like that. But that's how we help. We help to look at the entire situation, make sure that our solution matches your goals, and then use our products, which is either a refinance. Sometimes we'll use a second mortgage, like you talked about there, because of the penalty to break the mortgage is expensive. We'll just do a second behind it, and maybe just leave it open, and then refinance everything at renewal. Right, still going to be lower than what those credit card interests that they're paying. And then we can also look at using a home equity line of credit. And when it comes to some of the folks that are in retirement and seniors, sometimes we'll even look at a reverse mortgage.
That's excellent. I really like that you're saying you're looking at the goals and what they're looking at for the future and their cash flow and what they need instead of just okay, you need $100,000, you've got this equity, here you go, this is what we're going to put you in. It's, walking them through that whole process is really beneficial. And that's the value add, right, that you're giving to individuals.
Yeah, and I think this is how you and I work well together, right? It's like I'm going to get a client, they're going to come to me on a refinance, but if there's been situations where I just can't help them. There's just not enough equity in the house, and they're about to lose their home because of the amount of debt that they have. And a lot of times it's car payments and just credit cards and life situations. And so that's a clear handoff over to you, Kathy. Please help these folks because I don't want them to lose their home, right? So that's the first one. Any other questions?
Well, I was going to ask you what mortgage refinancing or restructuring options exist for consolidating debt,
Mhm.
but I'm not sure if you just kind of answered that.
Yeah, I think well, there's always different products when you thinking about mortgage. You got to think about it just like going out and shopping for clothes or any of those. There's different products, and so there's certain products that work really well. So when you're looking at the debt, we're going to look at okay, what do we need to pay off that makes sense? We want to look at each one of the liabilities and see what makes sense. What should we pay off first? And I think that comes from working with someone like yourself to say, hey, this makes more sense. Let's pay this debt off first because it's the highest interest and it's the highest payment, that sort of thing. So it's using people like yourself that have the expertise in that stuff. Really, for us, we just want to structure the mortgage so that it makes sense. Again, meets their goals, hits what they're trying to do financially to get to that monthly payment, and then paying off the debt and the liabilities that make sense. We may not take all of the debt and put it into a mortgage. We might just take part of it. It just depends on what we're trying to do. And like you said in the beginning, each situation is completely different, right?
Mhm.
Yeah.
Yeah. So when does it make sense to leverage home equity to pay off debt?
It's
Probably in the majority of cases, based
yeah.
on interest rate and payments and the longer payment plan, but I'll let you provide some information.
Yeah, again, I think it depends a little bit on where you are in your life cycle, right? So, are you in your 40s and you've got, 20 more years of working, or are you just coming into retirement? Are you buying you just bought a house and your roof leaked, your car broke down, now all of a sudden, you're not making enough income to cover everything, but you've got, put a massive down payment down. I think it really makes sense based on where you are in your current situation. So if you're struggling cash flow wise and you're carrying a lot of debt and you're only making your minimum payments, it's probably a good time to look at doing a refinance because you're never going to get out of that. You got to pay down just like paying your mortgage off faster. You got to pay the principal, not the interest, right? So if you're in a situation where you're making minimum only payments, if you're in a situation where you're struggling monthly and you can't breathe, but if you're struggling monthly because you can't go on a $30,000 trip, that's a different story, right? You really got it. If people that are in this situation, you really have to really tighten the reins on your spending and hold yourself accountable. Otherwise, you're just going to be in this situation again, right? So, I think anytime, like I said, anytime where you're struggling with cash flow, anytime where your debt is you're just making minimum payments, you should look at doing a refinance. Okay, that's my thought.
So, how does an insolvency impact the ability to refinance when the mortgage comes up for renewal? I know we talked a little bit about the interest rate, but is there ever a situation where the mortgagee will just say, nope, not going to refinance?
Yeah, let's talk about in mortgages in general. So let's say I'm a first time home buyer. I've been renting for 15 years. Just got married. We have kids. We need a bigger place now. But in my past, I had a bankruptcy. I'm out of it. But in my past, I had a bankruptcy. Is that going to impact you getting a mortgage? A little bit, for sure, because there is that risk. So the way lenders look at lending money for mortgages, they look at risk. It's as simple as that. If it's whether your payment history or the property itself, lenders will always look at risk. And if you had a bankruptcy, well, that's telling them that there was a situation in your past where you failed to make payments to a point where you had to use the bankruptcy. So is it an issue? Yeah, for sure. Does it mean you can't get a mortgage on the A side? Absolutely not. You can. What we're looking for is we're looking for you to be out of it for at least 2 years, And like you said, Kathy, with your advice before, is start to rebuild your credit. If they've seen that you've got good income, you've rebuilt your credit, even though you had a bankruptcy, you're still going to get a good mortgage. Okay. If you're now, here's the problem that a lot of people don't understand. So what I get all the time is, okay, I had a lot of debt, but I want to buy a house, so I did a consumer proposal. Now my debt's gone, but can I go get that mortgage now while I'm still in the proposal? And the answer to that question is no. So typically, again, they want you to be out of that on the A side. Can you get one? Yes, on the B side, but it's going to cost you. Interest rate's going to be higher. Again, there's going to be a lot of fees. And again, each one of those B lenders are going to take it case by case. They want to know the story. They want to know, what was it, because just you went out and racked up a bunch of credit cards because you're a spender. They may not lend to you, right? So it's how the mortgage agent really packages the story to the lender and explains the situation. But it also
Excellent.
will impact your credit rating. So there's that too,
Yeah.
right?
So I do, when you were saying about people having equity in their house and not knowing where to turn, there's been multiple circumstances recently where I may have an elderly person who has equity in their house, has credit card debt and that type of thing that they're struggling with, and they're on pension income alone.
Mm-hmm.
So when they come to me and I go through their budget and what there is in equity in their house and what they owe, and I said, maybe you should look and see, can you refinance, get a second mortgage? Their concern is always, well, I only have pension income. Will I be eligible?
There's a lot of products that we have for people in that specific situation. First of all, income is income. So we can definitely use pension income. We can use CPP, OAS. We can use even long-term disability, right? We can use, any type of spousal support. If there was a breakup and that happens a lot recently. There's a lot of gray divorces that are happening, and we can use spousal support and things like that. So, yeah, but the way we look at it, it's just like any other mortgage situation. We look at, well, how much you looking to borrow, and then what's the income, and the ratio's got to work, and that just means that we want to make sure that you're not borrowing more than 40% of whatever that gross income is, right? To keep it pretty straightforward. But yeah, we can definitely help that. There's also, and like I said before, there's also reverse mortgages too. There's lots of situations where you have a house that you paid $40,000 for that's now worth $1 million. You have no children. You have no one you're going to leave your inheritance to. However, you're not golfing with your friends, and doing the trips around to Greece or whatever, because you don't have a lot of income when all that equity is just sitting in the house. Well, those types of situations. Then why wouldn't you take out $400,000, $500,000, and enjoy your lifestyle for the rest of the days that you're here? You know what I mean? So there's
Mhm.
lots of options out there, and again, that's why you reach out to someone like myself. I'll explore those options at no cost. Right?
And have the plan to make sure when they're taking out that $400,000 that it's going in something a little more strategic to last for a while.
Exactly, exactly. You don't have to take out 400,000. You can,
Yeah.
hey, if I just need an extra $1,000 a month, you can do that, and then the interest that you're paying on that is very minimal compared to taking out a lump sum, right? So,
Excellent.
yeah.
So, how long after a bankruptcy or proposal can an individual qualify for a mortgage? I think you said about 2 years.
Yeah, it's a rule of twos, right? Again, so it's 2 years. They're looking for two trade lines. They're looking for at least $2,000 in a credit limit. You can get off. You can get away with doing having a car loan or something like that. But they're just looking for credit vehicles where someone's taking the risk and lending you money, and you're actually showing that you're paying it off. And we do it all the time. It happens. A bankruptcy is not something, and I'm sure you can talk about this better than I can, but a bankruptcy is not something you should be ashamed of. It's not. It's not with you forever. Life can get better, and it doesn't mean you can't buy a house because you had a bankruptcy. You absolutely can, and I
Mhm.
do it all the time for people. It certainly happens. So it's just making sure you've got a good strategy for yourself, right?
Right. Learn from the process, take the steps, move forward. That's what it's there for, to
Hmm.
provide relief to an honest but unfortunate debtor and allow you to move forward. So,
Exactly. Exactly. Anything else you wanted to chat about today, Kathy? Or do you think you'll
No,
cover
I've
that?
definitely learned a lot. I'm going to go away with the magic of those two numbers. I will remember that.
Also, can you talk about your website? I just saw it this morning. It's called Fresh Start Now.
Yes.
Talk to me a little bit about that. That was pretty cool.
Yeah, so Taylor Legal Inc. is the firm, right? That's the licensed insolvency trustee. Fresh Start Now is kind of our branding because that's what we're here for. We're here to give people a fresh start from the debt they've been dealing with. So the website is freshstartnow.ca. We rebranded it probably about a year and a half ago, just to kind of refreshen it a little. There's a lot of information on there. So as far as blogs and Q&A and some resources, budgeting tools, there's a page on that. There's information about bankruptcies, proposals. So yes, I thank you for mentioning it, and I direct people to go take a look at it.
Yeah, and I like there's just a real good user experience. So I can just click on it, fill out a quick walkthrough, explain my scenario, and that way we can set up time to have a quick call with someone like you to review my options, right?
Yeah, and I will say that with Taylor Devo, so we have two trustees, Jeff Lewis and myself, and Taylor Devo kind of differentiates ourselves from our competitors that when you submit that form, you're getting an email or a call from Jeff or myself. When you're booking an
Ah,
appointment, you're seeing Jeff or myself. So as of right now, that's, we really focus that you're dealing with the licensed insolvency trustee and trying to find a solution for you.
mm-hmm. That's awesome. So once again, Kathy, thank you so much for taking the time to let me interview you today and explain everything to our viewers. That's great.
Thank you very much.
Okay, bye for now.
Take care.